Hello and welcome to Money Life. This is Sucheta Dilal. Have you ever felt so tempted that you have a smartphone and you have a loan that you can get in seconds and you're desperate for money and you want to do it? I'm sure you haven't if you're watching this, unless, of course, you've lost money in the stock market or you have people around you who so desperately needed to pay a hospital bill or to pay fees or something where it seems like 10,000 rupees coming into your account in seconds is worth all the risk. And then that's when the story begins. You slowly sink into a debt trap because when money comes so easily, you don't stop at 10. Then you take a second one and a third one, and believe it or not, they're all available so easily, and they are driving people into a debt trap with no exit. It's not as though the government doesn't know it. The government is working on it, but what we discover at Money Life Foundation, which is a sister non-profit entity, is that the number of people who are caught in this and desperate, sometimes say that they're suicidal, is just rising. You need to know about this, not just for yourself, but also for people who are around you, people who help you, maybe your drivers, maybe people who work at your home, because they could be in a trap like this. Listen to some of these stories. So I'm changing names because Money Life Foundation is doing a study and we are not yet contacting all the apps. But I want to tell you, if you have a story to share, please tell us. Now listen to this. Kushal Nath earns 12,000 rupees a month as a contract worker. He has a family of 13, joint family. Yet he managed to borrow from six digital apps, each charging an interest of 36 to 40% per annum. And it was giving him an equated monthly installment, an EMI of 46,700, which is nearly four times his income. How did they lend? We'll come to that later. But the fact is that you can just draw this down so fast. Okay. And the first EMI as well as costs are already deducted. So if you want 10,000, what you actually get on your phone is just about seven because all costs are deducted. Now, Sandeep Khanna, he's a HR executive, earns 25,000 a month. He has 14 app loans, totaling, you know how much? 20 lakhs. Third, Ram Gopal, a chauffeur, relatively fat salary, 40,000. He owes 17 lakhs across five digital lenders. Vijay Singh, a delivery executive, he's borrowed from 20 separate creditors, including banks, finance companies, and apps. You know the total debt? 37 lakhs outstanding. He wants help, but we don't even know how he can help. He has no house, he has no property, he has no gold because it's all been paid off before this debt is accumulated. Finally, Bhushan works as a company manager, has run up a cumulative loan outstanding of 1.14 crore from 30 sources, including hand loans. This is higher end, okay? He and others, like software executives who come to us for help, earn well above 1 lakh a month. They are engineers, come from good companies, but have lost money, sometimes to stock trading. These are not exceptions. They are representative samples of distressed borrowers from emails which are landing up at Money Life Foundation almost every day. All have a common message. Please help me get out of this. I want to pay. I don't know how. The foundation began receiving these requests from early 2025. And we were reminded of 2010. That's the time the Reserve Bank of India cracked down on banks and NBFCs, which were dumping credit cards and personal loans on people and driving them into a debt trap. And RBI had said, you will offer them counseling so that you help them out of this mess because most people are young. Reckless credit card loans had actually ruined lakhs of people. It is happening all over again. We discovered this from early 2025. Similar desperation to avoid debt traps. We collated data from all these. We are not sharing names, but 107 digital lending apps have been examined by us so far. We looked at their fee structure. We are doing a study. And we then also approached the RBI and said, please do something about it. It's not that the RBI is not doing things. I'll come to it later. But a general finding is that the borrowing cost varies from 30% to 57.45% for a little longer tenure loan. It all depends on the company, the product, and your tenure. But there are lenders offering really short loans, sometimes called payday loans or whatever. The short tenure loans are charging, believe it or not, 1% a day, which works out to a stupendous 365%. This includes all kinds of costs, fees, and whatever. Borrowers fall into two broad groups. First, salaried or informally employed, like the names that I told you, almost invariably from the 26 to 45 age group. Every story that we hear starts with this. Why did you take the loans? Oh, there was a health emergency, father lost a job, I met with an accident, and the temptation to borrow on an app loan because it's so simple. They're bombarding you with ads all the time. When you're looking for loans, they find you. You know what happens. You know what happens when you're looking at YouTube. You know what happens when you're looking at Facebook. You know what happens when you're looking at WhatsApp. So this temptation is in front of you and they borrow. The second lot, like I said, educated, relatively well paid professionals, many of them engineers, invariably tell us that they have lost money in the stock market. And then, of course, a series of other financial blunders like loans that they made. We don't even know if that part is true, but the stock market losses are very true. Both groups arrive at the same crisis point where they seek help when A, their credit score is about to start, you know, going into failed, because they know that they can't pay those EMIs anymore. So many times the EMI is more than their salary or their monthly requirements. That is the time they wake up and start looking for who can help them. They have exhausted all sources. They have the intention to pay. Sometimes we are able to suggest solutions which allow them to get out of it because we have experts guiding them. The pattern raises an urgent systemic question. One, how is it that so many lenders, you earn 12,000 and 30 lenders are willing to lend to you? There's no sharing of data. Why on earth did we have CIBIL or credit bureaus? It is because companies wanted to know the ability of individuals to pay. So, how are individuals able to accumulate debt far beyond their plausible repayment capacity, not from one or two, but dozens of lenders? We have actual case studies and lists. So, this is not hypothetical. Either the credit bureau checks are failing, or these lenders don't care. They think that they're going to coerce people into repayment one way or the other. And clearly, the regulator is not catching them, or they're ignoring regulation and working their way around it. Now, the main point here is first of all the usurious rates. High interest rates are a starting point. Processing fees, like I said, these are all add up. Processing fees range from 2 to 15% of loan value. They're deducted up front. Several lenders charge late fees. You know how high the late fees are? 36% per annum on overdue amounts. Then there are bounce charges, stamp duty, service fees. All these add a layer of costs. On short tenure loans of 7 to 30 days, the fixed costs determine what you totally pay. So it may sound simple. A 500 rupee processing fee on 10,000 rupee 7-day loan. Annualize it, it's 260%. The loan's headline rate may be 30%, but the borrower is paying three times that. Now, RBI, like I said, has tried to address this from 2023, mainly 2024, where it mandated a key fact statement. So, lenders are supposed to disclose in a single annual percentage rate called APR all the charges disclosed as one number, which is the interest that you're supposed to pay. This the borrower is supposed to know before he signs. Now, the intent was to give borrowers one easy to understand comprehensive number. People are obviously ignoring it because they're desperate. But Money Life data has also shown that at least two lenders have structured their charges as fixed fees. So they're keeping them out of APR calculations. In fact, one lender shows there's also other discrepancies which RBI needs to monitor. For instance, one lender shows an APR of 35% on the website, but its App Store listing seems to suggest a daily rate of 0.25 to 1%, which translates to 91% to 365% annualized. Both can't be true at the same time. Is anyone checking? We don't know. What we know is desperate borrowers who have borrowed at high rates. Now, in 2025 May, RBI issued digital lending directions. They further tightened disclosures. They mandated that all charges, regardless of how they are named, have to be included in the KFS. So this fixed fee stuff should be out of the window. But discrepancies have to be checked. Why is it that APR says something and the app is actually indicating something else? Whether every non banking finance company, lending service provider partnership has implemented these in practice is a different question. Now, let me explain these two terms: non banking finance company, right? All these finance companies are registered with RBI. They are subject to very strict rules. So, they try to avoid it by partnering with what is called a lending service provider. Who's the lending service provider? This is the escape route. Under Indian law, only RBI registered finance companies can legally extend credit to the public. So, fintech companies have exploited this distinction by setting up what is called digital apps, which is just a software, it's not a lender. Yet, it acquires customers, so it's advertising. It assesses creditworthiness. God knows how they do it because 20 people are lending to the same guy who's hardly earning 12,000. They have proprietary algorithms. They manage the customer relationship. And more importantly, they manage recovery very ruthlessly. The loan, however, is formally dispersed by the finance company that's registered with the RBI. So there's a layer. RBI is regulating the finance company further lends. All the problems happen at the digital app level, which is the lending service provider. It owns the customer, originates the loan, recovers the money, and earns a fee from the NBFC for getting money, which it disburses. It kind of remains outside RBI supervision. It's only indirectly under RBI supervision because the NBFC is regulated. The structure obscures market concentration also because what are finance companies doing? They are partnering with multiple people. We have discovered one which has three separate lenders, but there may be many more. Like I said, our study is ongoing. The borrower has no way to know that these three guys go back to the same finance company and they may appear independent, they are independent, but the regulated entity above them it's the same, but they have no recourse. The complaints are at the lending service provider or the digital app. In September 2022, the RBI had attempted to fix this also. It made NBFCs formally responsible for the conduct of this lending service provider. In practice, however, it remains opaque because you don't have so many complaints if it was working, right? They're supposed to be grievance redress officers mandated by RBI. They're often listed as generic emails. And the borrowers tell us that it's very difficult to talk, to negotiate, or do anything. In fact, even a counselor says that you can't do much about digital apps. You can talk to credit card companies, you can talk to finance companies if you have a personal loan. But when it comes to digital apps, it is very, very difficult. RBI supervision is clearly weak and patchy. The RBI governor publicly warned that some finance companies were pursuing growth targets by pushing high cost credit at the cost of the borrower who couldn't afford it. It issued cease and desist orders to four NBFCs in October 2024, barred them from sanctioning and dispersing new loans. But that sanction was lifted in 2025. So, new rules, they think all is okay. We don't know what happened. Did they act fast? But these sanctions were lifted. As part of a broader attempt to remove usurious lenders, the Ministry of Electronics and Information Technology, METI, also had blocked two major apps in 2023. Even that was lifted. Google removed 4,700 illegal loan apps from the Play Store 2 years ago since they were not associated with registered lenders. Some had links to China, Bitcoin, what have you. All this shows it's a work in progress. There is more and more regulation, but what we are seeing and talking about is the actual user. We still have people with very little monthly income or sometimes no income, joblessness, who are able to borrow from 20, 30 people, which means the regulation is not reaching where it should. A bigger worry is another category of lenders. We've discovered at least 16 apps in the data gathered by MoneyLife where there's no verifiable finance company at all, no functioning grievance mechanism, and in some cases, no traceable legal entity either. For these operators, the real leverage is the device seeking permission. So, you know what happens when you're taking a loan, you get the loan in seconds, but you have to agree to give access to all your contacts when you sign up, right? So, they have all the contacts, all the photographs, call logs, everything that is on your phone. And they use it to morph your pictures, to harass you, to call your colleagues, family, relatives. It is a nightmare. And this is part of a recovery process that's built on blackmail, threats, and obscene images, sometimes driven people to suicide. These are distributed on social media. Sometimes they demand that you take a new loan to pay us back. But it's never ending unless you can pay it all because it compounds so fast. Somebody says, I just took a 10,000 rupee loan. That was just a few months ago. It compounds so fast that it's ballooned into lakhs before you know it. Like I said, it has driven people to suicide, and that's when the government sort of wakes up and acts, but not enough. Over the past 3 years, multiple agencies have worked at blocking these apps. The Enforcement Directorate froze some accounts linked to 719 crore fake loan app, but not enough. In fact, Aparna Ramchandra, founder of Rectify Credit, who volunteers as an expert counselor with Money Life Foundation, says these are not a few hundred, they are maybe in thousands, and they continue to prey on gullible and desperate borrowers. So, where are the gaps? So, RBI rules are fairly comprehensive on paper, but the regulatory response is a problem. Registration is required of all digital lending apps. They need to be listed on a central information management system, CIMS. So there's a public registry. You can verify app lenders. This is required. Remember those 16 which I talked about? The least that people should do is verify these people, those you're going to borrow from. Apps are not supposed to contact your people. They're not supposed to access contact lists, calls logs, whatever, beyond strict KYC requirements. We know that's not happening even today. Loans have to be dispersed directly into borrower accounts, no pool accounts. All very well. This may have stopped. There should be a cooling off period of at least 1 day. This used to be longer, but they say 1 day during which a borrower can exit. So you borrowed, you're tempted, you want to exit. The rule earlier was that you would get at least 3 days. RBI has compressed it to one. In fact, this not only makes finance companies liable, but RBI has been a little soft on them. There are a few more problems. First, RBI is concerned about exorbitant interest rates, so why not cap them? India used to have a cap on usurious lending, but there is no mandated cap, there's only disclosure. Now, you have to take into account the quality of India's population. Disclosure and APR is not enough. Second, the CIMS registry reaches only apps connected to regulated entities. So, what about those who are not registered, where others have to crack down? Enforcement Directorate, CBI, maybe the police, maybe economic offenses, but those are operating outside this whole system, and so they can continue to bother you. These are unregistered operators who are still able to find individuals with great ease. So while this government is blocking people who speak against it, these kind of apps are functioning with impunity. Third, making finance companies liable for the conduct of these digital apps works only if there's active policing and strict supervision of RBI, followed by deterrent, stringent, crippling punishments. You have to make it bad business to be lending at usurious rates and to harass people. That is clearly not happening. So, unless there's systemic monitoring followed by swift and deterrent penalties rather than just occasional cease and desist orders that are lifted, this is going to continue. So, RBI, as usual, is tinkering with policies, sound great on paper, not necessarily working on the ground. We need to address it, we need to fight for it. So, like I said, I'm saying it again. If you know people with experience, believe me, we're going to keep the names anonymous, but write to us at foundation@moneylife.in and let us make our study more comprehensive. If you like what I say, please do share it because you have no idea how many people are silent victims of digital apps and usurious lending. They won't talk about it, but when you share, they may have at least some way to get help or guidance. Thank you.